Hello everyone, welcome to DA Investment Academy.
In the previous lesson, I talked about the 4 basic questions that every trader needs answer to before they can engage the market. Let me recap. Number 1, what do we do? These questions pertaining to whether we should be buying or selling or stay out of the markets. And this can be found from the higher time frame. And once I can find the market directional bias, I will come to question number 2, which is where do I enter a trade? And there are good entries, there are bad entries, then there are absolutely horrible entries. So we need to know where to enter a market. So I will combine question 1 and 2 together to do this presentation for today. And of course, question number 3 is what if we are wrong, where do we exit the market? And question number 4 is where do we take profit if we are right? So today I'm going to spend some time to talk about my strategy in doing swing trading in particularly, because there are traders who wants to trade for the longer term. And we all know this slogan, which is the trend is your friend. So how do you actually practice that? So in today's lesson, I'm going to spend some time to talk about that. Now, we all know traders have different trading objectives. Some tends to want to hold positions and some do the intraday trading. So today in this particular lessons, I'm going to concentrate only on swing trading, how I use my methodology to actually adapt to position trading. So let's get started. Now, we always hear this slogan, which is the trend is your friend. But how do you actually use this slogan to actually implement your strategy? So I'm going to show you my version of how I actually trade with the trend, and I want to hold positions for a slightly longer period of time because I want to catch the larger trend. So in this particular example, I'm using the CME, which is the Chicago Mercantile Exchange Micro E-mini S&P 500 futures, which is a very, very successful product. Average trading volumes borders about 1 million contract a day. So it's very, very liquid. And if you remember my previous lessons, I talk about finding directional buyers from the higher time frame. Now, obviously, I would love to trade to give you the example from the monthly time frame. However, this particular contract itself, this product only started months before the pandemic, so we don't have very long historical data to do the monthly time frame. So I think the weekly time frame should actually be more than enough to let me show you how I employ my methodology to actually trade this S&P 500. So you can see the low traded was 2,174 even. That was actually the pandemic low in March of 2020. And the high traded was only 3 weeks ago. That is 5,368 and a quarter. So we can see that this particular chart here, I only have one color box. Okay, we can see that there's a series of boxes that actually accumulated into the all-time high at 5,368 and a quarter, and there's only one color. So this means I only have up AB. So the directional bias in this particular product for the weekly time frame is very clear-cut. The market is still in that bullish phase. So if that's the directional bias, what should I do? Now, obviously, if the market wants to go higher, I would need to be buying. But can I buy at the current price? So that is where we go down to the lower time frame to get our perspective. Now, this is the same chart, but this is on the daily time frame. And in this particular time frame, you can see that the low is 4,122 and a quarter, which is in late October 2023. The high remains at 5,368 and a quarter. Now, unlike the weekly time frame, we have a series of green boxes, which is the dominant trend, very much stay in play. But we also have a counter trend that is currently in place from the high of 5,368 and a quarter. So we can see the current box right now, the counter trend is currently where we are at 5,313 and a half. So do we take the perspective, because we already knew from the weekly time frame that the market is bullish. We also knew that the daily time frame remains very bullish. So the action is actually quite clear cut. I need to be buying. And should I be selling? No, I don't want to sell this particular product at this particular point in time. Obviously, things may change. But for now, based on what I can see from the weekly and daily time frame, the market is very bullish. So my action should be buying. Okay, so now let's go down to the next lower time frame here. Now, before I even go there, you'll notice that there are times when the market actually went into what we call a very deep retracement. Now, VDR stands for very deep retracement. In the previous lesson, I did mention this term before. So we can see why we want to be buying at the VDR, which is defined as anything between 78.6% to 100% retracements based on the up AB. Okay, so we can see that this up AB here, the current box here, the VDR where the 78.6% starts all the way to the 100%. Market technically can actually go as deep as that, and it did. Okay, we can see that in late April, the market went up to a low of 4,963 and a quarter, and only once, and then it started to rally again. So this is one of the reasons why, if the market have a deep retracements, it is a godsend, because if we can actually enter a trade in the VDR, our risk reward is superior, because can you imagine, this is 1 unit of risk, because all I need to do is put my stop just below 4,936 and a half, and just visual inspection, you can see this is 1 unit of risk. I have 1 unit of profit, 2 unit, 3 unit, 4 unit, 5 units of profit. So my risk reward ratio approximately is 1:5. For every $1 that I prepare to risk when I buy in the VDR, I have the potential to make $5. So this is the kind of risk reward ratio that we want. Okay, but it doesn't happen that often. But if it does, then we should take opportunity of that. Okay, so this is the daily time frame. Let me go down to the 4-hourly time frame. Now, for swing traders, I do not want to go below 4 hours, because I think 4 hours is the minimum I will go to for swing trading, because I'm going to position my trade. Just remember, the lower time frame you go, the more volatile the market is, and the signal may not be as reliable. So again, in the 4 hours, I can see that the dominant trend starts from 4,963 and a quarter, which is the same as the daily time frame. And I have a series of up AB, and it tells me the dominant trend in the 4 hours remains very bullish. Now, we also see that there is a counter trend starting from the all-time high of 5,368 and a quarter, and this is the second down AB box here. And here we can see that prices has gone into a very deep retracement. You can see visually, this is the 5,205 and a half traded at the beginning of this month itself. The market has gone into a VDR, and that is where you need to be buying. Okay, so because the dominant trend is up, we want to be buying, and where is the best place to buy? Like I say, if the market ever gives us a chance, if they have a very deep retracements, always take the opportunity to go in to buy, because our risk is going to be limited to just below 5,188 and 3/4. So again, based on a 4 hours time frame, this is 1 unit of risk, and 1, 2, 3, 4, 5, 6 units of potential profit. So in the lower time frame, it becomes even more lucrative to do the buy when the market goes into a very deep retracement. So this is where we are, but we need to have some rules in place. What are the rules? Now, these are my rules of engagement. In a up AB, in which we are seeing in the S&P 500, I only want to buy within the green box. I do not want to buy outside the green box, because there are times when the market actually price went above the up AB. So if that's the case, I won't like to chase, because when I chase, I'll be buying high. So the law of making profit here is very simple. You want to buy low, you want to sell high, or conversely, you want to sell high, you want to buy low. So it's going to be very difficult for me to be able to buy when the market is outside the AB box. Obviously, this is only reference to me. This is my personality. So I got to pick a system and a methodology that fits my personality. I don't like to chase, but there are others who don't mind chasing the market. Maybe they have a different strategy, but this is not how I want to do it. I only want to buy in an up AB. And if the market have a 50% retracement, which is very, very common during a typical pullback, then the 50% is going to be where I want to enter the market for the first exposure. Assuming I'm going to do 2 lots, okay, and I say, okay, I'm going to put half of my exposure at a 50%, because there is a good chance the market may not do a VDR, right? So if the market does go deeper into the VDR, which is 78.6%, all the way to 100% of the up AB, then I want to buy another half exposure, because my original rules of engagement is that I want to buy 2 lots now. Maybe I buy 1 lot at a 50% retracement point, and I buy another 50% within the VDR. So I want to put all my collective stops, okay, not exactly at A. A is the point of invalidation. If I'm buying, if prices go below A, that means I am wrong. I need to get out of the position, regardless of the reason. Okay, but I also is aware that there are times when the market do a fake move, meaning to say everybody knows where the stops will be accumulating. That will be an obvious pool of liquidity. There are times when the market will gun for those liquidity pool, and I'll try to avoid that as much as possible. Now, this is not a foolproof way to avoid being stopped up prematurely, but it at least give me a chance to survive a fake move. So I'm going to put my stop 0.5% beyond A. Okay, if it's up AB, I'm going to place it 0.5% below A. If it's down AB, I'm going to put it 0.5% above A. So it depends whether it's up or down AB. And if the market starts to rally without taking me out, then I want to take some preliminary profit. Now, remember, I have two exposure, one at the 50% retracement and the other one in the VDR. So between the two, the weaker position is actually the one that I bought at the 50% mark. So that will mean that I want to take care of that risk first. So if the market ever goes back to test B, the exact boundary of the AB boundaries, I want to take half of my exposure at B, meaning to say I have taken some profit and I now have more flexibility in whether I want to move my second half of my exposure, which I bought at the VDR, whether I want to move it to break-even point or whether I want to shift or my stop eventually or leave my stop where it is. Again, depend on situation. And I want to take profit at the projected D. Now, remember, the projected D is actually the 61.8% extension of the up AB. So this is how I will enter the base my strategy based on these rules that I set up for myself. Obviously, the down AB is exactly the opposite. Now, there will be some situation in which you want to hold the position for a bit longer, but again, let's talk about it when we come to it, okay? So for now, these are my basic rules of engagement. I will buy within the up, in the up AB, I will only buy within the green box. In the down AB, I will only sell within the pink box. And once the market reaches 50%, I will take up a first position, which is a preliminary position, which is only half of my original intended exposure. And then when the market have a deeper retracements, I would engage the other half of my intended exposure at the VDR, which is defined as anywhere between 78.6% retracement to 100% retracements of the AB. Now, I want to put all my stops at beyond A, okay? If prices goes and go beyond A, that definitely I'm wrong, but I'm also mindful for the fact that there will be some attempts to do a fake move. So I'm going to place a little bit of buffer, which is not very, very far away, 0.5% of whatever the A value is. And once the prices starts to move back in its original directional bias, I will take partial profit on my weakest exposure at the point when the price hit B. And I will take the other half of my exposure out at the projected D. Of course, price may go beyond projected D, but that is beside the point. As far as this system is concerned, it is a profitable trade. Now, go back to the 4 hours. This is the 4 hours time frame. Now, remember, now this is where we can see that there is a VDR, right? Okay, this is the 78.6% retracements, and there is also an opposing VDR, okay, over here. So again, because prices is inside the up AB, so I want to buy within the up AB, and I need to sell within the down AB, okay? But there is other thing that I also consider. If the counter trend is within the dominant trend AB, then I will not be considering trading counter trend. I will only consider trading counter trend if this counter trend happens outside of the up AB, which is above the green box. Now we can see that the counter trend is within the green box. So I am not looking to do a sell. Okay, in fact, I'll be very interested to do a buy. You can see that when the market goes into the VDR, the lowest traded was 5,205.5, and it only came once. So this is where I need to go in to buy, because when I buy anywhere within the 78.6% retracement all the way to the 5188.75, my risk is controlled, okay? And here you can see that if I do this trade, I have 1 unit of risk. I have 1, 2, 3, 4, 5, 6 units of potential profit. So this is where I would like to do a trade on the long side, okay? And if I am going to put a stop, what do I mean by 0.5% beyond A? This is the level, okay? Yeah, I think the exact level based on 5188 and 3/4 is 5163 point something, okay? So basically, I want to put my stop at this point rather than exactly below the A. So this is to give myself a little bit of a breathing room just in case there's a fake move if the market goes down and then bounce back up again. I want to avoid that as much as possible. It's not foolproof, but if it is not too deep a fake move, then maybe I can survive that trade. Okay, so again, this is how I will enter my I will do my swing trading based on this methodology. Every time the market goes into projected D and I have an actual D, I will have to redraw this box and I will employ these strategies in the same manner which I just described all over again. So this is the end for the lessons for swing trading. I hope it has been useful for you. I will see you in the next lesson. Bye-bye.